The year 2023 brings a lot of positive news regarding global inflation. It is set to fall from 8.7% in 2022 to 7.0% in 2023. Therefore, it will result in several investment opportunities that you can cash in on as an investor. Knowing where to invest your money is crucial because we all want to get rich while avoiding as many losses as possible. Well, that's what we're here for. In today's video, we will bring you the best investment opportunities for the remainder of 2023. We will tell you about several investment opportunities where you can invest your money for the best gains. Before we get into this video, please give this video a thumbs up and remember to subscribe to the channel so that you can experience all new videos from us. Growth stock funds. Starting, we have growth stock funds that focus on companies having strong potential for earnings that are above average. Another plus that they come with is capital appreciation. Capital appreciation is the increase in the market value of an investment over time. This includes stocks, real estate, or any other asset that tends to rise above its initial purchase price. And as far as investment is concerned, that is what we are looking for. However, there are risks of high volatility, overvaluation, and susceptibility to market corrections. Growth stocks are stocks that perform poorly in every market cycle. Dividend stocks. A dividend stock distributes a company's earnings to major stockholders. The company's directors decide the people who have the significant stocks. A dividend stock can be paid to the shareholder in cash or additional stocks. The received profits are divided amongst the people, which is how people make money on dividend stocks. The main player that comes here is voting rights. These dividends are approved by shareholders using voting rights. Usually, dividends are given in the form of cash. The company's net profits make up the dividends given to shareholders. The major chunk of the profit is kept by the shareholders, however. Dividends are also paid to the shareholders even if the company doesn't make suitable profits. This is to maintain their track of dividend payments made. As long as this track record is clear, it gives shareholders the confidence that the company will make payments shortly. There are several companies in which you could be a shareholder, so deciding your point of investment is crucial before you invest your money in a dividend stock. One good thing about dividend stock is that they are paid to you if you're a shareholder, even if the company doesn't deliver profits. But of course, if the company tanks, it isn't a sustainable idea to keep investing in these dividends. High-yield savings accounts. The third prominent investment on this list is a high-yield savings account, which pays you interest on your cash balance. This is similar to a savings account at your bank. High-yield savings accounts are accessible for you whenever you require cash. This kind of account is beneficial for investors who might need cash in the near future. A high-yield savings account works significantly well for investors who want to avoid the risk of not getting their money. Even though it is a low reward, it also brings a significantly low risk. With fewer overhead costs, you can earn higher interest rates at online banks than at your physical bank. However, that doesn't mean it is risk-free. Many banks that offer these are insured, so the least you have to do is not worry about losing your deposits as long as you stay within the federal insurance limits. You need to remember when investing in this type of account that you risk losing purchasing power over time if there is inflation and investment rates are low. To invest in this kind of account, you can search the banks that offer the best rates. Although you can also turn to credit unions or your local banks, you might need a different rate. Certificates of deposit. A certificate of deposit, CD, is issued by banks while offering a higher interest rate than a savings account. Short-term certificates of deposit may be a better option when you expect rates to rise, thus allowing you to reinvest your money at higher rates when the CD matures. CDs are good for investors who can afford minimal risk, especially those who require money at a particular time and prefer to tie up their cash in exchange for a bit more yield than they would find in a savings account. Remember that CDs can have a significant hit on the purchasing power of your investment. Although CDs are considered safe investments, they come with a tiny risk. When interest rates fall, investors earn less when they reinvest principal and interest in new CDs at lower rates, as was the case that was seen in the years 2020 and 2021. So, what is the end goal of a CD? The financial institute that issues it to you pays you interest regularly. Once it matures, you regain your original principal and any interest you might have gained. The case of CDs is the same as that of a high-yield savings account. in the sense that even though you could go to your local banks or a credit union, you won't get the best rates from them. Corporate bond funds. Moving on, we have corporate bond funds in which corporations and companies raise money by issuing their bonds to investors. These are then packaged into bond funds that own bonds issued by hundreds of corporations. Short-term bonds usually show maturity over 1 to 5 years, making them less susceptible to interest rate fluctuations than intermediate or even long-term bonds. Corporate bonds are funds that are an excellent choice for investors looking for cash flow. This includes retirees or individuals who want to reduce their overall portfolio risk but want a healthy investment return. Short-term corporate funds are a good shout for risk-averse investors who want a little more yield than government bond funds. Corporate bond funds aren't federally insured. There is always a chance that companies will end up having their credit downgraded. In other cases, they might default on their bonds. To reduce this risk, you must ensure that your fund comprises high-quality corporate bonds. The reward in these short-term corporate bonds is that investors are rewarded with higher returns than government and municipal bond funds. However, greater rewards come with added risk, so potential investors should always consider this. Corporate bonds can be bought and sold with any broker that allows you to trade ETFs or mutual funds. Value stock funds. We are now moving on to value stock funds. These investments are priced at a bargain compared to other investment funds. When stocks rise in value occasionally, many investors wonder where they can put their investments, and value stock funds are a good option here. These are great for investors comfortable with the volatility surrounding investing in stocks. Investors in stock funds need to have a bigger horizon. Therefore, they must be extremely patient when investing in valuable stock funds. The least they should look at is 3 to 5 years to straighten out any bumps they might find in the road. Value stock funds are far safer than others due to their price point. They are bargainable, but beware. They are still composed of stocks, meaning they will fluctuate now and then, like short-term bonds. Another thing you need to know about these bonds as an investor is that the government does not insure them. On to the good part. Value stocks tend to rise as interest rates increase and growth stocks become relatively less attractive. Value stock funds are obtained in 2 different types: mutual funds or ETFs. Mutual funds require a minimum purchase along with the commission. ETFs are available to buy without commissions or a minimum purchase requirement. REIT index funds. A real estate investment trust, REIT, is one of the best ways to invest in real estate. REITs give you dividends for not being taxed as a corporate entity. REIT index funds then pass those dividends to investors. REIT funds that are publicly traded include tons of stocks for you to buy. These stock varieties include lodging, apartments, offices, and much more available in a single fund. REIT index funds are a fantastic way for investors to get exposure to real estate without worrying about managing the property themselves. For income-focused investors like retirees, REIT index funds offer sizable dividend payouts, which entices them. However, REITs also frequently increase in value over time, so capital growth is still possible. Investors must have a long-term perspective and be prepared to deal with volatility, because the prices of publicly traded REITs can change significantly. REIT index funds offer diversification, allowing you to own several REITs within a single fund. But again, one crucial element to remember, like all the other investments told above, is that your interest rates will rise as your fund price fluctuates. So, how do investors make a profit off of this investment plan? As dividends and capital appreciation enter the picture, they will bring profits. Over time, a REIT fund can earn almost 12% of annual returns, plus dividends. Sounds pretty neat. You can buy a REIT fund from any broker that allows you to trade ETFs or mutual funds. ETFs are usually commission-free, whereas mutual funds may charge you a commission and a minimum purchase. S&P 500 Index Funds. Since the S&P 500 Index Fund is based on around 500 of the biggest American corporations, it includes many of the most prosperous global businesses. For instance, 2 of the most well-known members of the index are Amazon and Apple. An S&P 500 Index Fund is a fantastic solution if you wish to attain larger returns than more conventional banking products or bonds, albeit it does have more volatility. An S&P 500 Index Fund is an excellent option for novice investors, since it offers extensive, diversified exposure to the stock market. Any stock investor searching for a diversified investment who can commit to holding their investment for at least 3 to 5 years should consider an S&P 500 index fund. This is one of those funds that is a less risky way to get into stocks because it's highly diversified and includes the biggest companies the market has to offer. One downside is that the government doesn't insure it so that you can lose money depending on the fluctuations in its value. The standout feature of this index fund is the diversification it brings to your portfolio. Conclusion: all the investments said to you in today's video will bump up your portfolio while bringing you decent profits. However, before you invest even a single penny, it is essential to understand where you are investing your money and the realistic time frame before you start to get returns. A little trial and error is allowed, but once you get the hang of your investments, it's a smooth ride from that point onwards. That's all we had for this video. Once again, remember to give this video a thumbs up and subscribe to the channel if you would like to see similar content from us. Until next time.